Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to the latest installment of our 2024 Second Half Outlook podcast mini-series. Unlike equities, global bonds and most major FX pairs have had a challenging first half of the year to date. Of course, that is the rear mirror view. Most importantly, what is the outlook for them in the second half of the year? I'm delighted to have Manpreet Gill, our CIO for Africa, Middle East, and Europe, back to delve deeper into our views on bonds and FX. Welcome back, Manpreet. We've discussed earlier that the Fed may be ready to cut rates in second half. What does that mean for bond investors?
Hi, Jong. Thanks for having me back. Yes, you're right that we do expect the Fed to start cutting rates in the second half of the year. And for bond investors, regardless of the type of bonds you invest in, if they're denominated in US dollars, history reminds us that dollar bond yields generally peak not far from when the Fed stops hiking rates rather, and falls near or ahead of the start of Fed rate cuts. Now, there's some debate, of course, over the exact magnitude of how much yields might fall, but it does argue very strongly for locking in today's yields where that makes sense. Now, to dig a little bit deeper, if we start looking at developed market bonds, we do see developed market investment grade government bonds as a core holding. Risk reward does appear fair given where market expectations are for Fed rate cuts at the moment. And we do expect, the 10-year US government bond yield to stay not far from recent ranges, but of course, as we discussed, with a bias to the downside. So about 425 to 450 on over a 3-month horizon, and 4 to 4.25% over a 12-month horizon. So a little bit lower from where we are today. If we move to credit, investment grade and high yield corporate bonds, the yield premiums they offer over government bonds do remain quite low relative to how much they've offered historically. Now, we do see support from strong quarterly earnings, and our view of a soft landing scenario for the US economy should keep default rates for high yield fairly contained. In addition, we note that high yield bonds in developed markets, high yield corporate bonds, we don't see them facing significant refinancing pressure this year, which also should support performance. So, all in all, not a bad outlook, but we're leaving it at a core holding, more and we balance the positives with the valuations. I think just one note maybe on maturity profiles. So we did discuss, of course, soft landing being our core scenario, and bond yields potentially being lower, but we do think the risk reward of going excessively long on maturity profiles might not be very attractive. So given where market pricing is relative to the one rate cut that we do expect the Fed to do this year, we believe a 5 to 7 year maturity profile on US dollar bonds is where risk reward is most attractive.
Manpreet, you spoke a lot about developed markets bonds. What about emerging market bonds? Do you see a little bit more value over there?
Well, I think the answer is yes in some cases and no in others. So it's a little bit more about finding those pockets. Where we do see an opportunities in emerging market US dollar government bonds, that's where we have an overweight view because we think the valuations are attractive and the fundamentals are increasingly supportive. So yes, geopolitical tension, softening commodity prices, those are challenges. But we do believe yield premiums do compensate investors for that. And we do think that fiscal balances, external balances across the EM universe are starting to improve, particularly when you look at improving foreign exchange reserves in recent quarters on average. I suppose if we look a little bit broader within EM, when it comes to Asia dollar bonds, we again have a neutral or a core holding view. The asset class has performed largely in line with developed market high yield bonds, a little bit better than investment grade, of course, year to date, but high yield really driving that performance. Now, one concern here is in recent years has been the fact that the Asia high yield remains dominated by Greater China issuers. But actually, given that some of the stresses in China property are now more than well known, we do see geographical and sector exposures much better balanced today compared to a few years ago. And when it comes to the property sector specifically, we do believe high yield now very well prices the ongoing defaults in that sector. So that again gives us a little bit more comfort. So that's, I think, what sort of, in our view, adds up to a core holding view on Asia dollar bonds. The only asset class where we have an underweight view is emerging market local currency bonds. And where that really comes from is that, well, the yield is still not bad. We do believe the risk reward of taking on emerging market currency risk is not attractive at this time.
Well, since you touched on currencies, let's move on to the currency markets. FX market volume, it remains relatively low, but we do see some divergence between some central banks cutting while others are not. What are your key convictions within the currency markets?
Well, a few convictions, but I think in many cases the ranges are low because, as you mentioned, FX market volatility remains very, very low. But I think a big tone is set by the US dollar. We do see the dollar index, or what's commonly referred to as the DXY index, rising a little bit over 1 to 3 months to 106. And there's a technical reason for that. It remains in an ascending trend channel. But also from a relative yield perspective, we see the Fed holding rates for a little bit longer than other major central banks like Europe, which have started cutting rates. But once we get through that period of divergence, we do expect the dollar to soften back towards 105 once the Fed actually starts cutting rates. Now, overall, I think when you sort of contrast that now with what we're seeing elsewhere, some other central banks have started cutting rates ahead of the Fed. So I think that's where we see a bit of a window of opportunity, particularly with 3-month horizon, that some currencies could weaken against the US dollar. So starting with the euro, where we expect it to depreciate modestly towards 1.06 over the next 3 months. And that driven, of course, by the ECB cutting rates ahead of the Fed and what we see as a resilient greenback. And we think that ECB, of course, has room to cut twice this year. The other one, of course, is the Bank of Japan, which took a much more gradual approach to tightening policy than markets expected. So what that means is, against the context we described, it's quite possible that dollar yen continues to move towards 160 over a shorter 1 to 3 month horizon. We do think it'll strengthen thereafter quite a bit back towards 150, but again, a 3-month window, there might be an opportunity there. And finally, the Canadian dollar, we think that has room to weaken, especially relative to other major commodity currencies, because unlike central banks of Australia and New Zealand, we have a fairly dovish Bank of Canada, softening wage growth and slowing retail sales. So at least on a 3-month basis could lead to some currency weakness before it starts to reverse over a longer 12-month period.
Any big winners in this environment?
Well, I'm not sure I'd go to the extent of calling them winners, but particularly when we look at longer 12-month horizons, some currencies are starting to gather, some potential positive catalysts. I think one area to look at is the Swiss franc. So while it might weaken slightly over a 3-month horizon towards 90 cents, we do think when you start looking out over the next 12 months, which takes us to mid-2025, inflation risks and growth indeed have both pushed a little bit to the upside. So that could hold the Swiss National Bank from easing quite as much as some other major central banks. And especially when you contrast that against what we expect the Fed to start cutting rates later this year, means this dollar CHF could fall towards 86 cents over a 12-month horizon. So that's one area. Second, again, dollar yen, as I described, while we might expect yen weakness over a 3-month horizon, the reality is we still expect the Bank of Japan to maintain a tightening bias. And once the Fed starts cutting rates, that could lead to dollar yen pulling back towards 151 over the next 12 months. And finally, maybe in Asia, put in a few potential opportunities. The rupee, we believe, of course, should remain supported around 84 against the US dollar over the next 12 months as a persistent central bank purchases limit Indian rupee gains. So a bit more upward pressure, perhaps capped by the central bank. And in Singapore, we think dollar Sing could move towards 133 over the next 12 months as the MAS leaves policy unchanged and maintains sort of an appreciating bias.
Thank you for that deep dive into our H2 bonds and FX view, Manpreet. That's all the time that we have for today. Thank you so much for your kind attention. If you enjoyed the podcast, please like and subscribe to the SC Money Insight channel. Happy investing.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.